What is bottom-up risk analysis? Well, perhaps it's best to start with top-down risk analysis. And a good example of this is the analysis of foreign currency risk that corporations face in emerging markets, in particular, Asian markets. Suppose that the currency is pegged to the US dollar. If we use our standard tools for estimating risk, we look at the beta with respect to a currency basket against the US dollar. Indeed, it would be a regression of a company's return, or if the company doesn't have stock data, a company like it that's got equity data, regress against the world market, regress against the currency basket change, and you get a beta, where you look at the currency of that particular country is a possibility too. Now, what happens if the currency of that country is fixed, pegged to the dollar? Then the beta that you actually estimate is zero. That risk model, a top-down risk model, would suggest that the sensitivity of that firm's returns to a change in the exchange rate versus the US dollar is zero. And you assign a zero risk. Now, the problem is that that type of analysis looks back in time. And looking forward into the future, there's a probability of a devaluation. So it's not that realistic to assume that the risk equals zero. So what I've proposed in some of my research with Andrew Roper is to actually look at the bottom-up, firm-by-firm approach. And we applied this model in particular to Asian corporations. In Asia, we noticed before the crisis in July 1997, we noticed a number of things. First, we noted that profitability of these firms had been decreasing throughout the 1990s. We also noted that the leverage of the firms in Asian markets had been dramatically increasing. And third, we noted that the leverage had two characteristics. One, it was mainly short-term, which meant that you had to refinance after, on average, 2 years. And second, that it was almost all in US dollars. So these firms actually created a situation where they had fairly high risk exposure to an exchange rate change. Yet traditional methods would say that they had zero risk exposure. So what we did is we built a model from the bottom up. So we looked at the actual characteristics of each individual firm. We looked at their debt. We looked at their bonds, their loans, figured out what currency they were in, figured out the sensitivity in terms of cash flows to that particular firm and to the value of the firm to a change in the exchange rate. Given that a large portion of this debt was in US dollars, it's almost immediate that you can calculate the sensitivity in terms of value to a change in the exchange rate. So what this analysis allows you to do is to do a what-if scenario. What if there's a 5% realignment in the exchange rate, which is a moderate realignment? What if there's a 10%? What if there's a 20% realignment? This type of bottom-up risk analysis is also very useful for country analysis, because we have actually demonstrated that if you look at numbers like 5 or 10 or 20% in terms of devaluation, you can figure out the number of firms in the economy that are going to be put at great risk. There comes a point where, for example, if 30% of the firms are insolvent, that is going to have countrywide implications. So this bottom-up risk analysis doesn't just apply to individual firms. We can use this bottom-up risk analysis to get a sense of the country risk. So if there is a devaluation of a certain percentage, it will push a sufficient number of firms into distress that really pushes the whole country into distress. This sort of analysis is an ex-ante analysis. It looks forward, it doesn't look back, and has a lot of advantages over the traditional top-down method.